All right, welcome everyone. Once again, I'm here, Kevin Kim with Brocious, here with one of my very favorite clients and friend, Noah Brocious from Capital Fund One out of Arizona. It's hot. It's August. We're still in the pandemic, so we're doing this via Zoom. Welcome, Noah. Thank you for joining us.
Yeah, absolutely. Thanks for having me today.
Oh, yeah. I mean, we try to find guests, and one of the things that I've been kind of doing is asking clients to join us who have built a sizable company, who manage a fund, been in lending for some time now, and it's kind of interesting. A lot of folks, you guys are kind of one of the sleeper funds out there, the bigger funds out there, but still considered one of the sleepers, right? A lot of the guys in California still don't know who you are. I think you like it that way.
Fly under the radar.
Right. But and I know about the company, and I know how you guys have grown it, and you guys have managed a sizable amount of AUM. So, I wanted you to join us today and give the audience a little insight into who you are and the company and your partners, and kind of give us your story. It's been what? I haven't seen you about 6 months, right? We're usually at conferences together every other month, but
yeah. I think the last one was out in Newport. I don't remember when that was.
That was a good one. Yeah. But I mean, since then, the world's turned upside down. For a lot of different reasons. Yeah. How have you been? Have you been safe? How's the family?
Yeah, been great. Family's good. My son turned 5 yesterday.
Oh, congrats. Nice.
Yeah, so that was cool. We ended up giving people the option to work from home. I don't know when it was, mid-March, something like that. Mm-hmm. I worked from home for 2 days, and then my wife looked at me and said, "You got to get the hell out of here." So I've been in the office for pretty much this whole time. So it's, obviously things have been interesting and strange, but it's probably been a little bit more normal for me than a lot of other people.
So you basically came back into the office right away, but like the office is a ghost town, I'm guessing, right? Most people are working from home, that kind of stuff. Some guys choose to come in.
No, we're pretty much at full strength. We have some.
Oh, nice.
Yeah, we kind of, I don't know, end of April had about half of the staff in to start, and then brought everybody back in. But like I said, we're spread out, trying to, putting our masks on when we can't social distance, things like that.
Right. And there was, because I heard in Arizona, much like here in California, it was kind of the double spike. Like you guys had another. So has it caused anything recently for you guys?
No, not really. We instituted some more rules and be more strict with people being in the same office and masks and things like that. But I think it was, part of it was a function of more testing. Part of it was a function of idiots going to bars and parties and stuff.
Yeah, a little overdoing it, right? Yeah.
I know a couple people that got it, and everybody knows why they got it, that I know.
Right.
Nobody's like, I don't know, I was staying at home. I was like, I went out, or I went to a party, or so. Mm-hmm. So anyways.
Right. Well, it feels like to me that at least that it hasn't. We've been talking about this for some time privately, and it seems like the pandemic hasn't necessarily affected your guys' company too much. Things seem to be booming, right?
Yeah, fortunately not. March was our best month in company history because, the pipeline was already full.
Right.
We really didn't go back and change any loans that we had committed to. We thought it was, be dependable versus overreact and piss off some borrowers. So March was super busy. We did 98 loans in March. April, May, June, we slowed down a little bit just because we made some adjustments like everybody. We increased our rates a little bit, lowered our leverage a little bit, and then started collecting prepaid interest on all of our loans.
Right.
I think for the most part, we were collecting 3 months of prepaid interest. So that we put some natural governors on it. So I think we averaged,
like most of the industry, but you guys didn't go like complete left field. You guys didn't start adding like 12 months or anything like that, right?
No, not too crazy. So I think we averaged about 50 loans a month in April, May, June. So we still stayed pretty busy. But the thing that was interesting is payoffs accelerated. They didn't slow down at all just because our real estate market's going crazy here in Arizona. So payoffs kept coming in, and then July, so kind of mid-June, we adjusted back to really where we were pre-Rona, as I like to call it. So yeah, July we had another record month. We did about 107 loans, funded about 30 million. So
That's
yeah,
great. I mean, that's. I don't think I have any other client that has such a positive story. Well, I mean, speaking of it, we've been catching up, but I want to make sure the audience gets to know a little bit more about you and the company. So tell us a bit about yourself and about Capital Fund One, a little bit about what you do, what you lend in, that kind of stuff.
Absolutely. So I'm a Arizona native, born and raised, went to college out in California in Thousand Oaks, went to California Lutheran. Needed a school that lets little white guys play basketball. So basketball there for 4 years. That was fun.
Nice.
Yeah. And then came back here, started my career, tried to sell insurance out of college. And that was a failure in progress. That didn't. I'm no good at selling the last thing that people want to talk about to them. So
right.
Realized that wasn't for me, and I got into real estate in kind of late 2004, and I've really been in real estate since then. Started out doing some land development, kind of buying and selling some land out in Arizona. Pretty crazy back then. Pre-Great Recession. And then 2007, I went and worked for a commercial developer, Panettone Development, actually based up in Sacramento. So I worked in the Arizona office until I got laid off in February of 2009. So the world kind of stopped in real estate. And then I hooked back up with my buddy Justin, who I'd gone to high school with, who I worked with, he and his dad, Mike Anderson, from about 2004 to 2007. Mike was the founder, or is the founder of Capital Fund One. They had started, really, they were buying properties at the trustee sale auction. So they needed some help. They were doing some flips. Needed some help with that. And then while we were doing that, we met some investors down at the foreclosure auction, down at the courthouse steps. We made a couple loans, and then just decided that we liked the lending business a little bit more. So we started to focus on that. Started the fund with about $2 million of Mike's money back in 2009, and have just grown it from there.
You came out right at the birth of what we consider hard money, then, right? Right, 09.
Yeah, absolutely. Yeah, and it started, and it still is, asset based. So we don't check, we don't get third party appraisals. Yeah, we have a good solid team. That
was Arizona as strict as they are now back in 09
on the lending side. Yeah. No, they tightened up. They started to require licenses in, I think it was late 2010, early 2011. So
Dodd-Frank was on its way. Yep.
Right. We weren't licensed to start, but then got our banking license in 2000. Right. Yeah.
So fast forward to 2020. It's been, you guys had your 10-year anniversary last year.
Yep. Yeah.
So you're actually the same as ages in the law firm. We've been around since we started in 07. Yeah. And a little bit older. Yeah, a little bit older, but still, we started right then. And Anthony started the firm during this recession, and hard money just took off. Cool. So you guys started with the fund right away.
Yep, we did.
No trusted investors, none of that. Just started right away.
No, yeah, it was Mike's money to start, and then he just started reaching out to friends and family, right, to raise money, and then their dollars were just added to his dollars. Everybody got a share of all the loans in the portfolio.
And at the start, it was a 3-man team, the three of you.
Yeah, so it was Mike, Justin, and I, and then one other person, Kristen, as she joined us right after we started.
Are they still part of are they still all active in the company, or are they taking are you now kind of leading the charge, or?
Yeah, so just myself. I'm the president of the company now, and then Mike is the CEO. So as far as the original team, we're the only two that are still.
Nice. Well, that's so good to hear. I mean, and So right now, I mean, so you started a fund right away. Fast forward to 2020, you guys have how much under management now? How much? I mean,
we've got about 200 million out.
Okay.
Of that, we've got about 135 million in equity, and we have a line with Western Alliance Bank. That
and that 135 in equity was organically raised locally through your guys' networks, not like big capital partner or anything like that.
No, just all friends, family, and referrals.
That's crazy. So when you guys started, were you doing what everyone else did, like, just fix and flip and residential construction and that kind of stuff, or was it a little more diverse back then? Because you guys are pretty diverse now. You guys entertain.
Yeah, it was really just purely fix and flip stuff to start. And when we started, we were only lending on properties that were purchased at the trustee sale auction. Mm-hmm. So it was good because in Arizona, it's a little bit different than California and some other states where if you win the bid today, you have to put down a $10,000 deposit, and then you have till 5 p.m. the following day to pay in full. Mm-hmm. So we had a little window as long as we quickly. So we cut our teeth on 24-hour funding, which was good. It just,
you learned the skills then, how to move quickly, how to underwrite. Yep.
So it was all 6-month term for the first, probably 12 to 18 months. And then we added, a longer term loan, 24 months for some rental properties. Cause, back then you could buy a house in Maryvale for $35,000. Yeah. And we'd make a loan of 25 and the investor could rent it out for, $700-800 a month. So you could cash flow even at, 16-18%. Mm-hmm. We did that. Then we added some ground up construction, loan program. Then we started lending on land and commercial as well. So yeah, well, as long as it's.
How fast did that evolve though? Like, were you guys all of a sudden adding them year by year, or was it like, was the construction stuff more recent? How did that evolve?
Yeah, I mean, it was, for the first probably 18 months, it was just the short term fix and flip. And then, we added the 2-year rental program. Then a year later, we added the construction program. Then probably within 6 to 12 months, we added land and commercial. So we didn't add them all at once, but
I mean, you guys have a skill set in the constructions. I mean, the development company and all that. So makes sense.
Yeah, absolutely. Yeah, the partners, the other partners in the company, we've got some great skill sets too. One of the partners, Buddy Satterfield, was the Arizona president of Shea Homes for about 20 years. He's got a ton of background.
And he knows all the builders too. Then he's not going to mess around with him.
Yeah. And then Mike Anderson has land development background. Dean Bloxham started iMortgage. They merged with Loan Depot back in 2014. So he's got a strong lending background. And then Mike Lofton has a framing company called Lofco here in town. So he understands construction.
So a lot of expertise.
Yeah.
Are those gentlemen that you described, are they on the board, or are they all like principals of the company?
Yeah. So they're principals of Capital Fund One. So they act as an advisory board. And then one of the reasons we've been able to raise capital is that between the 4 senior partners, as we call them, they've got about 30 million invested in the fund. So it's not a situation where we're going to investors and saying, "Hey, give us your money. We promise that it's lend it."
Yeah, that's why you guys have all put your money where your mouth is, and you believe in your product. That's capital raise 101. If you don't believe in your own product, then exactly. So I'm trying to picture the industry because I remember the industry back then. I mean, were you active in the space as you are now, or was it more kind of local in Arizona only, or?
Yeah, really, we just kind of had our heads down. We were making as many loans as we could. We were staying busy, especially at the beginning. I mean, there just wasn't that much capital available. So
sure. And real estate deals, values were lower back then, and you didn't need as much capital. Arizona's evolved over the years.
Oh, it has, yeah. And we just, back then we'd lend until we ran out of money, and then, we were kind of out of business until we got some payoffs. So we were able to raise some more money.
Right.
But I would say, putting that line of credit in place with Western Alliance in 2014 really helped, because that gave the ability to grow even further.
Oh yeah, I mean, they've provided a valuable service to the industry. I mean, they've allowed folks to grow organically, and also they encourage folks to be kind of the model you have, like control their own business essentially.
Yeah.
So you've seen this cycle essentially from start to finish, because you guys started in 2009. So let's talk about the company. So you guys started with just the three of you. How big are you guys now? How many employees do you guys have now?
So there's 15 of us that are
still lean and mean.
Yeah. We try to keep it as lean as possible. So yeah, there's 15 of us full time, and then the four senior partners that I mentioned. So yeah.
And how many of those are more like LOs, and how many of those are back office?
Yeah, so we've got, what do we have now? Four loan originators. Well, five now. We actually just hired somebody out in Colorado and opened an office out there. So yeah, five originators. We have four people that are in kind of the underwriting, asset valuation, default REO management department. Two people in marketing, and then the other six in more back office, so processing, closing, servicing, accounting. So yeah,
nice. Still very lean for considering the amount of volume you guys do. That's great.
Yeah, we created a pretty good little assembly line system. Everybody knows their role.
Right.
And sticks to that. So
I mean, I imagine that was a challenge at first, right? Kept figuring all that out, building all, stepping over yourself, you were probably wearing what, 6 hats at once, probably, right?
Yeah. I mean, it was good, because we were forced to learn every aspect of it. So yeah, that was, it was fun for a while, but then you kind of get to a point where you start to get burnt out a little bit. So
right. Well, when was that? When was that moment where you kind of started to focus on highest and best use, if you will, right? And so servicing and asset management is not shouldn't be your day-to-day responsibility. Yeah,
absolutely. Yeah, I mean, we ran really lean until about 2016, 2017. I mean, we still only had, I think, 6 people back in 2017. But then, yeah, we realized, okay, this is a business we're going to be running for a while. People that are here can't keep doing what they're doing, or else we'll burn out. So we gotta allow people to specialize a little bit. So
that's kind of indicative, because that's when the market really started to take off. In 2016, it was like the market just exploded.
Yep. Yeah.
Well, so let's talk about, you mentioned Colorado. So you're not just an Arizona lender. You lend in multiple states, Western states, I'm guessing, right?
Yeah. Yep. So yeah, Arizona primarily. We're getting Colorado up and running. We're making some loans through participation loan agreements up in Oregon and over in West Texas.
Nice. Great markets.
Yeah.
Oregon's tough. The licensing rules there are tough. How about any vision to expand beyond that? I mean, my home state sucks. I mean, just pricing's ridiculous out here. But
your state scares me. I don't know.
It scares me.
I mean, isn't there some new tax?
Oh, they're trying to pass all kinds of taxes right now because they're out of money. So there's talk about a retroactive tax now.
Right.
Well, how are you gonna do a retroactive tax? You gonna send me a bill?
Well, yeah. What's the one? There's something about, like, if you lived in California and made an investment, they're gonna tax.
Oh yeah, that too. Yeah, right. Yeah. And then there's a lot of stupid bills about. There's this really, really dumb bill about the foreclosures and. Oh gosh, I mean, we're once again the great Republic of California, the Socialist Republic of California, but. But I mean, a lot of guys out where you are, a lot of competitors, they're starting to kind of expand, right? They're starting to go into different states, explore maybe some of the non-judicial, some of the judicial states, and plans to move out beyond that.
Yeah, we're looking at some other states. I mean, I think we like the Western United States. So yeah, we've got our eyes on on a couple other markets out there.
Still same asset classes, right?
Yeah, same asset classes. I mean, we're control freaks, so we don't want to lend on stuff that we don't understand. So we're
Right.
going to expand, but slowly once we can find the right people. Because an asset-based lender, we have to know what the real estate's worth and be able to value it.
Right.
It's all portfolio. So yeah, we just got to make sure we have the right people in place.
And I heard something there that was kind of interesting. So you guys are control freaks. You guys are lean and mean from before. Does that have anything to do? Has that influenced why you guys haven't suffered so much during the pandemic? Because I've just seen so many different versions of the story. Right? I've heard some folks just like completely shut down. Some folks, are kind of on skeleton crew, bare operations, and others like yourself thrive through it. What do you think it is? What do you think that allowed you guys to really, I guess, thrive or just maintain, right? Because you guys really didn't suffer that much during the pandemic.
Yeah, I mean, I think that it's easy to kind of take your eye off of what your specialty is and what you're good at, and also, we've seen a lot of people, even borrowers, that they kind of get the God complex. They think, well, this has worked for so long, I can just go and do anything. And, on the lending side, maybe I don't need to require a down payment from this guy because he's doing such a great job and things like that. So we just stuck to our guns, always requiring down payments, not getting overly aggressive with borrowers, really sticking to our bread and butter has always been single family residential.
Right.
So we've got, about 650 loans in the portfolio. So our average loan amount's about $300,000. We've got a good, healthy, low loan amount.
Right. Really. So you guys didn't change your parameters. You guys stuck to your parameters. You guys. Yeah. It sounds like you actually stubbornly stuck to them. You didn't ever make accommodations.
No. Yeah. We'll make some subtle adjustments, but yeah, for the most part, we're really doing what we were doing from the beginning. Just
right.
People.
That's an interesting way to look at it. For a lot of the listeners out there, because a lot of people are like, well, they want to know, kind of, like how is it? Like what's the difference makers for the guys who are doing okay or doing well? Mm-hmm. I've always told them, well, number one, they manage their own capital, right? They're not reliant on somebody else's money.
Yeah.
And that's been my kind of thing, because that's what I do for a living, right? I help them build funds. But
yeah,
I didn't really, the whole idea of really sticking to your guns and that kind of proactive way to protect yourself, because if you did that the whole time, then your portfolio is not at risk at all, even if the ground shifted underneath you. So yeah. Does it have also? What about this though? Arizona's real estate values have been significantly climbing. And people have been moving there. It's become a haven for a lot of folks out from my state, but also it's become a very attractive place to live. Has that kind of helped? I don't know. I've heard multiple lenders from Arizona have different stories. So, Yeah,
we see it as a positive because people are continuing to move here in droves. It's still, you compare it, our median home price is still $300,000. So
right.
To San Diego, LA, Seattle, even Denver. It's so much more affordable to live here. You gotta deal with 115 degrees in the summer, but as long as you're not a roofer, most people can live through that.
Or you're a suicidal golfer in the summertime, right?
Yeah, but like right now we have, last time I checked, I think there's 8,500 homes on the MLS for sale. And last month there was 9,500 sales. So we literally have less than a month of supply. And because of the natural governors in place for builders, pre-Great Recession, I think in 2006, I think we built 55,000 or almost 60,000 homes here. But with labor and material shortages, even if builders wanted to try to get back to those numbers, they wouldn't be able to. we have an inventory issue, which, as long as rates stay low and inventory stays low, the simple supply and demand says pricing is just going to continue to go up. But
Right.
they're still really affordable compared to other Western United States markets.
But there had to have been so many instances. Like, I remember 15 and 16 were the years when, this market started to become very, very crowded, and a lot of folks, to compete, started to make that compromise. There had to have been moments where, like, you guys had those meetings where, like, maybe we should make these adjustments, or maybe we should make these changes, or maybe we should start selling to whoever. Tell me about that.
Yeah, no, we did. And I'm not saying, like, when we started, it was 20% down, no questions asked. And it's just the absolute best we're going to do. But we've learned over time, having to foreclose on properties and sell them as REOs. We've learned what's liquid and what isn't liquid.
Right.
So we've definitely gotten more aggressive on, single family residential under 300,000. We'll do that loan to a good borrower with 10% down.
Mm-hmm.
So we've definitely made some adjustments, but as far as our structure and the fund and just continuing to raise money and not get distracted by, well, if we sell, maybe make it more profitable, things like that. We've been fortunate to just always have investors that want to give us more money too. So we've never, knock on wood, we've never needed to raise money and not been able to raise money.
Right. Oh, let's talk about that real quick, because that can be a significant challenge. I know a lot of people who are starting up or going into a more direct lender situation, and they want to control the capital, but their biggest big question mark for them is the capital raise, right? So we can couch this as more of an insight, like, if you're advising someone like who's thinking about going out there and doing it. And let's talk about that, because raising money is not easy, right?
No, it's a grind. Yeah, and Mike Anderson was really the one that did the heavy lifting as far as that went, just because he had the connections and knew
the network.
Had the network. Right. It was still, it was, in 2009, it was on the heels of, Scott Coles and Mortgages Limited and Bernie Madoff. So people would, you try to raise money for a
mortgage business.
Back then, people kind of looked at you like you had three heads. So, so it was a grind, but I would say, if you don't have a good chunk of your own money to put in the fund, it's going to be that much more difficult. So, like anything, skin in the game, it just goes a really long way.
Right. And for a lot of folks who come in, a lot of times they ask, well, what about hiring folks to do it for you, right? Like, I get asked a ton of times, and people ask me all the time, do you raise money? I'm an attorney, man. I don't. My bar card says I'm an attorney. I didn't take the Series 7. I can help you, but I'm not in the business of doing that, right? And I always tell them, look, this is your first fund. You should also think about doing it yourself, because you gotta get to know your investors. Have you guys ever entertained that, like, hiring a broker dealer or hiring a registered investment advisor, or just outsourcing it in general to go out there and raise the money?
Yeah, we've thought about it. We've considered even more hiring somebody. Again, we're control freaks, so just having the less third parties we have, the more or the better I sleep at night. So, and I don't know. We like being able to have those conversations with the investors to make sure that, because as unfortunately, everybody doesn't read every word of every document.
Oh yeah. Right. And everyone has different sources of information, right? And so they may interpret, and they freak out, so.
Yeah, so we typically get in front of our investors if they're interested. We meet with them. We make sure, they completely understand the investment. And it's good just to hear feedback from outside sources too, because sometimes you get so caught up in what you're doing, just to have another person's insight and opinion. A lot of times we've gotten ideas of, how to tweak things just from having those conversations in those meetings. So yeah, maybe someday, but for now we're going to continue to raise, through our network.
And the network being, they're all high net worth investor.
Yeah.
Primarily local money. Is it primarily in Arizona, or is it spread out now?
Yeah, for the most part, Arizona. I mean, there's some people that, like most high net worth individuals, they have a home somewhere else.
Yeah, they move to Wyoming or yeah.
Yeah, anywhere but Arizona in the summer.
Right. Right. Canada.
Yeah. We've got a handful of Canadian investors. So yeah, it's for the most part, it's all local people.
That's something that to look over. I mean, from a lesson standpoint, like, I did an interview with Romney over at Noble, and he kind of had the same sentiment. Like, the majority of their capital comes from local money, and I mean that helps. I mean, you guys are able to actually go out there and meet them. You can drive out and meet your investors.
Yeah,
if they're spread out the United States, it's going to be tough.
Right.
Let me ask you this though. I mean, because at $100+ million, the size of a fund is always not indicative of the size, like the number of people you have to manage, right? So, I mean, how many investors generally? Let me just get specific. How many people? How many actual investors are you dealing with? We have over 100 people.
Yeah, we've got about 100. I think about 130.
Okay.
They'll have maybe a self-directed IRA and then a personal account.
Okay.
But we've got about 130.
That's still manageable from a messaging standpoint and meeting standpoint.
Yeah. And again, having people that are local, they understand what's going on. They listening to the news, or I don't know if anybody reads the newspaper anymore, but reading the newspaper, or, searching on Google or whatever.
Right. They're feeling the same thing you're feeling.
Yeah.
Not too far away. Yeah.
And we've really been, one of the things that's been really important to us is educating our investors. So
how do you guys do that?
We send out, we disperse to our investors monthly. We send out a monthly newsletter. So it just updates them on the portfolio, what it looks like. And every month we pick a topic just to discuss. Sometimes it's the market, the real estate market. Sometimes it's a new new concept we're coming up with. But yeah, we're always just trying to do the best we can to educate our investors.
Is it done in person, in writing, both?
We do it in
video.
Writing. Yeah, we do it in writing. We have a meeting every year. This year, probably not going to happen.
Yeah.
But yeah, we get together at least once a year with our investors.
Do like a state of the fund kind of meeting.
Yeah. Hotel,
banquet hall, drinks, dinner. Yeah. That's great. And that's some of the things that's overlooked. Is like, I always tell folks, like, when it comes to managing a fund, it's like not just about can you raise the money and can you put it to work, but are you managing your investors? Like, are you communicating with them, managing them? Because it's still, at the end of the day, it's their money, right? So.
Oh yeah, absolutely.
And let me ask you this: with that as a backdrop, when Corona hit, and Arizonans, their response was kind of right there in the middle, like, let's not overblow it, let's not overdo it on the other end, let's not lock everything down. How were your investors? What was your investors' response? Because a lot of people in California, the investors lost their minds the first month, right? And same with some other states, So.
Yeah, I mean, for the most part, we didn't hear from too many of them, so everybody stayed pretty calm. I mean, we had a handful of people that reached out. Nobody really freaking out. Just, all right, how's it going? We had a couple people that had, just because of the industries they were in, revenue went to zero overnight.
Hospitality.
We had one investor. He owns 4 daycare centers.
Oh,
those are immediately illegal.
Yeah.
So yeah, we had a few people that were in tough situations, but yeah, for the most part, again, I think it helps with the education. They understand, okay, borrowers got skin in the game. We're at, portfolios at 65% loan to value. Real estate's still selling. I think really understanding it better helped our investors stay pretty calm for the most part.
And that's really, if you dissect that statement though, right? Because they are getting monthly statements about what your lending parameters are, what your underwriting parameters are, how the fund is performing, all this great stuff.
Yeah.
So they know what you're doing, right? And the transparency in the community, that's important, because then they're not going to be asking questions. They're not going to, they're not asking questions that they should already know, I guess.
Right. Yeah.
Well, I want to ask you about kind of the kind of life cycle of the company now, because we talked about you guys started in 2009, you guys started adding people, you're at 15 employees now. Has there been anything was there any specific episode in the past 10 or 11 years now that really kind of shaped company culture and how you're going to, what the kind of really defining moment for Capital Fund One?
I mean, I think Mike set out from day one to really, just put the culture in place of, being responsive, always, my thing is just always do what you say you're going to do. I mean, right. It seems so simple, but nobody does it. We had a couple, challenging bankruptcies that we had to go through, really two at the same time. It was back in 2014, 2015. Those were interesting. I mean, we learned a lot, that's for sure. But yeah, I mean, I think it was Mike's intention from the beginning, just to be a dependable source. And I think I've kind of carried that on since he's not as active in the. But
it's just kind of surprising, right? How simple that is, but a lot of times supremely overlooked. Just integrity, answer the phone, respond to email. But you'd be surprised, right? But I mean, and I can't echo that. No, we do that. We have the same values here as a company. Yeah, but it's just surprising how and I find that it's those simple things that really define a culture.
Yeah,
it's really cool.
Like my wife still gives me crap about it, but we got married. We just had our 5-year anniversary. But at that point, I was the loan originator. There was 4 of us. Yeah, and I had to work.
Yeah,
I could not answer my phone. I could not respond to emails. So, it's just doing what you say you're going to do, and no slow no's. I mean, if it's a no, just give them the no.
Straight shooting. Yeah, there's not enough of that in this space. A lot of kind of drag on. I think I can figure it out and try to make it happen. Yeah, and eventually it's not going to work, right? And most folks should be able to know right away that's not going to work. It's just not possible, So, well, that's cool. I mean, all right. So you guys have been around long enough, so I can ask you guys this question. I get a lot of people coming to the space. It doesn't matter what time of the industry it is, right? It could have been. It was very, very busy in 16 when a lot of new lenders showed up, but it's still busy today. We still have a lot of folks that are former LOs or come from a different industry and love this industry, and they're investors or they're builders, and they want to start doing it. And they want to start up a new business. They want to start become a lender, right? I'm going to ask you, with your experience in both real estate and in finance, what kind of guidance do you have for these folks?
I mean, I think the more, again, going back to being a control freak, I mean, the more aspects of the business you can control, especially to start. I mean, a lot of people say, okay, well, I can outsource this and I can outsource that. And, even to this day, we service all of our loans because I wouldn't, I'm sure there's some great servicers out there, but I wouldn't trust anybody else to service. Right. So I think, getting started, even if it means working 20-hour days, you gotta control as much as you can because overly dependent.
Well, so it's not a part-time job, ladies and gentlemen.
Not even close.
Yeah. It's 2 jobs, really.
2 or 3. Yeah. So just not thinking you can just, hire somebody to go raise money, hire somebody to service, hire somebody to, underwrite or value properties. I mean, you gotta live it. eat it and breathe it to get started. And then, over time, I think you can do some of those things. But yeah, if you think
and why is that? Is it expertise? Is it so you can actually, step in and fight those battles, even if you're not in the trenches with the new employees you have covering that, or?
Yeah, partly that, but also because, if you're dependent upon a bunch of other people to do things, you can't control how quickly, you can tell people, yeah, I'll get back to you in 2 days. But if you have 3 people that you're depending on to get back to you, you have no control over your responsiveness.
Right. Too many cooks in the kitchen, too many levels of communication that need to happen. That's true. That's true. I never thought about it that way. That is very true. A lot of times, it happens with me sometimes. You the assistant, and then I could quickly get back to the person real quick. And it's kind of interesting how that plays out.
Yeah.
So,
yeah.
Anything else? I mean, how about like business wise? Like, a lot of guys come out saying they're just going to do it by themselves. You had a team with you. You had partners. I mean.
Mm-hmm.
If someone came, if I came to you and said, I'm going to start this by myself, just me, what do you think about that? You got into something like that?
I mean, I think unfortunately we had a lender here in town who was a one-man show, had no checks and balances, nobody to tell him, what he was doing was stupid. And unfortunately the guy ended up losing a bunch of money to one investor in particular, and ended up killing himself. So I hate to bring up such a terrible example, but
I know.
I think you have to have checks and balances. You have to have, you've got to have at least one other opinion, somebody to bounce things off of. So, I mean, I don't know. I wouldn't be a proponent of a one-man show. Mm-hmm. You start drinking your own Kool-Aid. So yeah, I would definitely try to stay as lean and mean as possible, because that way you learn everything that much more quickly. And like you said, when something comes up, you're already familiar with it. You've already worked on it. You can jump right in. But yeah, I would say you still want to have a small team, even if it's just 2 people. Yeah,
I mean, the idea of basically not believing your own bullshit sometimes is important. Mm-hmm. And you may lose sight of things. Entrepreneurial spirit can kind of get the best of us. So,
absolutely. Yep.
I'm going to ask you this. So we another kind of question I always ask more seasoned lenders is, the industry is in a weird place right now. Mm-hmm. It just like went, 2008, 2009. To 16, from 16 to now, just been expanding. This is the first kind of what I would consider a substantial challenge the industry has ever faced, because it's a relatively young industry. Where do you think we're headed? Where do you think we're headed as an industry? And what thoughts do you have? I guess where we'll be, next year, right around this time, 2021. Hopefully, we'll be in Vegas having a drink, but
Yeah. Yeah. I mean, I think there's always going to be a need for short-term capital. That's a little bit easier to secure than going to a bank or a conventional lender. I think, real estate as an investment option for people in the U.S. and the world just continues to get more and more popular. What the stock market's been overvalued for 10 years now or whatever. So I just think, I think that there'll always be a demand for what we do. And I think, my crystal ball's foggy. The world's weird right now. We obviously have an election coming up. I think, on November 4th or 5th, I'll probably be able to tell you a little bit better where we're going to be.
Let's see where things go. Right.
Yeah. Either way, I mean, definitely not going to get into politics here, but no matter what happens, our industry is still going to be in good shape. There may just be maybe a little bit better or a little bit worse, kind of depending on what happens in November.
Right.
Yeah, I mean, it's like anything, like this whole pandemic has been interesting because, you just see all these businesses that, some of them just bury their head in the sand, close the doors, they're gone. Others have gotten creative. I mean, there's trampoline gyms that are doing, that have computers set up for kids to do school in. I mean,
yeah.
There's just all these different, it's just been really cool to see people get creative and just see how hard people fight, that really care.
The necessity, right?
Yeah.
I mean, I remember very early on, there were a handful of restaurants that were doing the outdoor dining thing. They started doing the outdoor dining thing. And now every restaurant's doing it. But and there were a handful of barbers that were starting to do the outside haircuts. Now everyone's, and all types of creative ideas to make money.
Yeah.
And survive. And I think our industry is no different. You're right. I agree with you. I think the asset class is always going to be needed. It's always been needed. It always will be needed.
Right.
I just wonder, was that blip between, what was it? When did Wall Street jump into our space heavily? Was it 15, 16? Was when they were all here?
Yeah.
Those were from 15, 16 until about last year. I think the market was just really, really frothy in our space.
Yeah.
And I wonder, is it ever going to be as frothy ever again? Or did we scare off that kind of capital? Or is that even a bad thing? Right? I don't have an opinion about it. I mean, I'm an attorney. So I have to deal with as legal issues come. So.
Yeah,
I want to get your thoughts on it.
Obviously, is somebody that has a fund and doesn't sell our notes.
Right.
I don't mind it at all. It's just reduce some competition. But again, I think most or all of those sources will be back. Maybe not as aggressively as they were before, which is probably a good thing. I mean, people shouldn't be able to write chunk loans with little to no money down and be able to sell them.
No money down. There were a lot of those out there for a while.
It's just, I mean, you're just asking for, what do you think people are going to do when it comes down to making their payment on their investment property or feeding their family? I mean, it's not even a question. So
right.
If you got no equity to protect, and that's what we learned. We always thought, okay, as long as we require a down payment and the world doesn't end, people are going to protect their equity, and that's what happened. I mean, our default rate went from 4% in March to we're at 1.5% right now. So through Corona, our default rate went down significantly. Because
they have more down payment, they have more skin in the game right now.
Yeah, exactly.
And they have the interest prepay, so
right. Yeah, that definitely helped too. Yeah.
Well, that's a good way to look at it. I mean, I've always wondered about the outset of all that, how it's going to play out. I've taken the same stance, and they're going to come back. There's money to be made.
Oh yeah.
There's tons of money to be made. It's a question of who and at what terms. And how fast will it devolve is my wonder, because it devolved pretty fast when they jumped in. In less than about a year, we were seeing 100% financing.
Mm-hmm.
So my only hope is that it doesn't devolve as fast.
Yeah,
we'll learn the less, because it's interesting because a lot of the people in our space that came out of the last recession learned their lesson, right? Mm-hmm. And those guys built these big companies like yours, and they're not suffering that much because they've been pretty conservative.
Yeah.
And then if there's a different breed of lender out there that kind of joined the industry a little later. Now they're learning that lesson again. So I'm wondering how that's going to play out. And I hope it does. I really do. I really hope a lot of folks take a more conservative approach, because you can still make a ton of money in this space and be conservative on the term side. Just as long as you don't, chase that dragon.
Yeah, no chasing the dragon.
Yeah, there's a lot of dragons we chase, though, man. It's easy money to be made. It's a lot of folks.
No, and it's hard. You see those shiny objects, and it's like, oh man, this. I really want to make that loan, but then you just got to remember, okay, for me, I want to be doing this for the rest of my life. I want my son to be doing this.
Right.
So, making an extra $100,000 today to screw up the future is definitely not worth it.
Long game, for sure. Well, that's a good place to put the industry. I hope it's the way it goes. I really hope we don't suffer too much.
Yeah.
I mean, resi seems to be coming back pretty strong, right? I mean, overall, I've heard positive things on the resi side.
Mm-hmm.
I just don't know where we'll land on the commercial side. This time it seems to be commercial. And I've been saying it for years, commercial is going to have its own bubble burst.
Yep.
And I think this might be it. I don't know. I mean...
Yeah, that's one that's tough because, do people continue to go to hotels? So...
Right.
That big question mark. Retail has big question marks. Even office. I
mean, there's no need to go to the office. A lot of folks are shrinking their offices down.
Right.
Renegotiating those leases.
Yeah. If companies just start to say, we're fine, we don't need office space.
Right.
So that one, and that's anybody's guess at this point. It's just we're gonna gotta see how it all plays out. So
makes sense to me.
Yeah.
Well, I think that's all we have for today. I mean, it's about an hour in. Noah, I want to thank you for joining us on the podcast today.
Yeah.
For those of you, we're going to put your website and your link all here. For those of you who are listening who are borrowers, this is the guy to talk to. Honestly, he's a good friend of ours. We love Noah at the firm, but also a good friend of mine. Hopefully, we'll see you soon in person. Have a drink.
Sure.
Hopefully. I think November, we're all talking about being in Las Vegas in November, so
I know. I'm signing up.
Yeah.
Let's
if I can make it, I'll be there.
Yeah, sounds good.
Yeah, for sure, man. Well, I hope to see you soon, and you guys stay safe out there, and we'll make sure to put the firm on the after credits, and maybe we'll do another one of these soon with some more folks.
Yeah, I'll be ready anytime.
All right, man. Thank you very much for your time today. And we'll catch up soon, man. Take care.
All right. See you.
All right.